If you see the daily fluctuations of the financial markets, they're nonsensical, highly erratic behavior. But this is what the entire world is relying on in the financial industry and everything connected in with it. Markets need to consistently be growing, and periods of slowness are highly detrimental to this garbage system. You came here for the truth, so let me unveil that for you. If you've been watching this channel for a little while now, you know I do not beat around the bush. I get right to it. So let's begin by taking a look at a few charts. This is out of Bank of America Merrill Lynch. They do these surveys with their fund managers. And essentially the biggest tail risk today is, once again, month after month after month, as I've shown you here, trade issues. The trade issues going on with China and the US today are at the forefront of the madness that we see. They are actually putting this ahead of quantitative tightening, which was from earlier in the year the biggest concern. Apparently that has changed today, although I disagree. I think the QT is going to be the reason why the stock markets decline. Now, how did I figure that out? Well, what I did was I looked at what happened last time. I looked at the time before that, and the time before that, and the time before that. And it just so happens that every single time we have a drying up of liquidity, the stock market comes along with it. There are different trigger events that take place, but ultimately there's some form of QT going on at that time. Now, if you look back in history, going back a few years ago, the Euro sovereign debt crisis was the number one tail risk. Then it was, oh my goodness, can the US pay their bills? I don't know. And then we get into the point at which we see in 2018, where there's a lot of different risks today than there were, let's say 5 years ago or even more. But looking at this, it starts to worry me. What exactly is going to be done to correct these issues? And the fact is that they won't do anything. What do you consider the biggest tail risk? This is a different way to look at the graph, and you can see that trade issues between October, which is the darker blue, and September, which is the lighter blue. Clearly, there has been some change, and that quantitative tightening is starting to grow and trade issues are starting to shrink, but you could see how it looks on this chart for yourself if you are interested. Now we look at the most crowded trade, and once again, hallelujah, we see that long FANG is in fact the trade of the day. And that doesn't surprise me. I wonder if we see the next month's numbers, which I would obviously show you, how this becomes a change. I don't know. We're going to see it. But clearly that has been the trade. It is very obvious. I mean, look, long NASDAQ during this whole period of time in which that was the trade for such a long stretch. And then we get into, which is basically even worse, not only is it just long NASDAQ, we're actually going long on the FANG stocks and the BAT stocks. But looking at this for quite a while, I mean, right through 2017, all the way up until present day, that has been the trade of the game. So we'll see how it works in the near future. At this time, in which phase of the economic cycle would you say the global economy is? And nearly 100% of individuals surveyed said that this is late cycle. Almost nobody said it was mid cycle. Almost nobody. So we're looking at this being very clear to everybody. Now they might say, it's going to be 2020, 2021, and who knows? I don't know. That's for sure. But the fund managers are starting to say, it's probably 2020. They're never right on the short or the long, so we'll see how it goes. How do you think the global real economy will develop over the next 12 months? Net percentage expecting a stronger economy. That is significantly on the negative side there. That is quite funny, actually. As you look throughout 2017 into 2018, they're not looking good because you can't just extend this further and further with a bunch of FANG stocks. Look at what happened. A few of them started dropping, took everything with it, and we had several down days in a row. Today, as I record this, happens to be an up day. Earnings season is going to be so wonderful, and as we've seen historically, earnings season has meant a lot more to the stock market than ever before in history. It is, as I said in the introduction, nonsensical, but here we are. There's any news at all to make the market go up, even if it's bad news, somehow makes the market go up. It doesn't really make any sense, but hey, that's the world we live in today. This shows you the quarterly share buybacks of the S&P 500 at record levels today. We are seeing this now. I want to know what's going to happen before the end of the year and how much they purchase. This absolutely would not surprise me to see it go even beyond expectations. They're expecting over $1 trillion. They're expecting, in fact, twice as much as they saw last year. And last year was a significant amount. So twice as much. We'll see what they do. Now, this right here could be a factor in pushing the markets up higher before the end of the year. If they're going to put another several $100 billion in there, it might help. It might help to push these markets up. I'll be tracking it, that's for sure. Overnight interest rates, more free money. Carry trading liquidity. Banks borrow money overnight, then deposit the money at the Fed, earning additional interest on excess reserves. Okay, so that's the way this works here. You could see these lines on the chart: overnight deposit rates, repo rates, and interest on the excess reserves. Looking at that, which connects in with this point. Excess reserves on depository institutions, 2.2%, that's the Fed funds rate, of $1.7 trillion is $38 billion annually. Okay, so looking at that massive number, you have to look at the profit that's being made from these, as far as I'm concerned, criminal organizations. Competing factors: the interest rate is rising and excess reserves are falling. So then we have this problem where you have interest rates rising, which is good for some, but not good for the economy as a whole. At the same time, they're suggesting that excess reserves are falling. All right, so we're going to keep an eye on that, and I want to be able to closely pay attention to whatever the Fed does. And speaking of the Fed, your favorite and mine, Jim Cramer. That's right, Jim Bear Stearns is doing just fine. Cramer warns central bankers to stop Fed-mandated slowdown before they kill the stock market. What the bulls need right now more than anything else is for the Fed to be proven wrong. Cramer has been railing against what he calls the Fed-mandated slowdown since last week's market meltdown. Powell needs to recognize the signals of a slowing economy and stop raising interest rates, according to Jim Bear Stearns Cramer. Now, looking at what he said, it's very obvious that if you want the market to continue rising, well, it's an absolute matter of fact, you need to keep the easy money flowing. You cannot bring it back to normal levels. You cannot restore reality if you want the market to continue higher. You have to keep it at artificially low interest rates. Well, we'll see what the Fed does. I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, well then, these two books have it all. You can actually take a look through them at the link in the description. It brings you over to Amazon. Then you could flip through the pages for yourself. And if you're more interested in the audiobook version, you can get that at themoneygps.com.